All right, you're good to go.
But isn't aren't other people gonna join? Well,
That's all we have for then. Like this I best to start now.
okay. So for this meeting, I'm going to cover an introduction to quantitative finance. And the reason we're focusing on quantitative finance rather than normal finance is because there's many different branches of finance, and this one particular focus more about machine learning and artificial intelligence and computer science, and that aligns more with our goals. So, what we're going to be covering is what is quantitative finance, the math involved, financial markets, pricing theories, risk management, algorithmic trading, and career paths in this field. So, quantitative finance is a field that isn't really reliant too much on finance. It's more about mathematics, computer science, and statistics. And so it's the people in this field use mathematical and uh, models along with programming to analyze financial markets and price securities. They also use it to manage risk, and it replaces human intuition. Instead, the computer does the work for them. And then the goal of this is to make as much money as possible on the stock market while minimizing risk. And this can be divided into four main categories, and that involves high frequency trading, derivative pricing, risk management, and then market pricing. And so the main math involved in this includes stochastic calculus, which is still used, but it's less common now because there are many flaws after the financial crisis in 2008. Then there's Monte Carlo simulations, which is essentially it takes many different random outcomes and then uh, it uses a computer to predict certain variables and outcomes. And then there's multivariable calculus, which students often actually take in high school if they complete calculus BC first. Then there's partial differential equations. Then linear algebra, which is heavily reliant on vectors and matrices, and then it's used to optimize portfolios. And then there's risk modeling and probability and binomial distributions. And so, example of one of the main things in quantitative finance is Brownian motion, which was proven by Albert Einstein. And so, what it just shows is that markets are random, and so the goal of this field is to try to predict them as accurate as possible, even though it's really difficult to. And so then the financial markets and instruments involved include equities, fixed income, foreign exchange, commodities, and derivatives. And so equities would include common stocks like Apple, Microsoft, or Amazon on an exchange. Then there's preferred stocks and ETFs like the S&P 500. Then fixed income like bonds. Foreign exchange would include foreign markets like the UK London Stock Exchange, and then commodities like gold, silver, and copper, and then derivatives including stock options, and then so this something called the main Greeks, and so these are variables that are used to uh, make decisions. And the first one is delta, which is the sensitivity of an option's price. So basically, if it's the relationship between how the price of the stock might change and then the price of the option. And then theta is the decay of an option. So if you have a high theta, um, your stock might lose its value very quickly. Then gamma is the rate of change of the delta relative to the change of the price. And then Vega is the option sensitivity to how volatile it is. And then Rho is how sensitive an price of an option is to interest rates. And then so the core pricing models includes discounted cash flow, which many people might have heard of. It's used almost in every finance field. And then there's the Black-Scholes Merton model, the binomial tree model, and interest rate models. But for this presentation specifically, we're going to focus on discounted cash flow and Black-Scholes. And since this is a very brief overview, uh, we don't have time to go far in depth. But basically, this is the call option price, the stock price, and then it's subtracting the strike price, and then this is raised to the negative RT is the time to expiry, and then this is tracks the volatility. Then there's portfolio theory, and basically this is like what you would might have heard of. Like your portfolio should be diversified, and what that means is you should have many different sectors, like maybe utilities and then business and technology, and you should try to make it as uncorrelated as possible, so that if one sector goes down, then maybe the other does not go down along with it, and that protects your portfolio. And then there's capital asset pricing model. And so it's the risk free rate plus the beta, and then it's the market return minus the equity risk premium. And so then the goal of this is to have the least risk possible while being able to compensate with higher returns. And so this actually leads to many different metrics like the Sharpe ratio, which is just how much the portfolio returns based off of how volatile it is and how much risk is being taken. And then there's risk management, which is market, credit, liquidity, and operational risk. And then there's value at risk and expected shortfall. Then stress testing involves like making putting the portfolio through many different scenarios and then seeing where it fails, where it does well. And then there's regulatory context, meaning like uh, firms need to comply with the law. Then there's algorithmic trading, which is basically uh, you write maybe a piece of code, maybe in Python, and then you use that to do your strategy. Like you might write a very basic Python script, like buy when the stock is over 100, sell when it's less than 50. But that's the very basic part of it. So the benefits of this is that it can save a lot of time and automates many things. But then downsides might be is when a model fails, there's a chance that a lot of money can be lost. And then this also involves backtesting, where you check to see how your portfolio may have performed in previous years, which is not always very reliable, but it can be useful. And then the tools and technology involved in quantitative finance involves Python, R, MATLAB, and C++. And then the major libraries include NumPy because it's much faster, Pandas for data science, and then SkyPy and QuantLab. And so Python is very useful for making models and like visualizing data analysis. Then R is more heavy on statistics. MATLAB is also very good for visualization, and then C++ is very used because how fast it is. It's much faster than any other programming languages like Python. So it's often used in high frequency trading. And so the careers in this are usually divided into a few different roles, and that involves a quantitative researcher, which is usually someone with a PhD in math that tries to develop new algorithms and methods in the field. And there's the quantitative developer, which basically is like a software engineer, and they often write code in C++ to make it as fast as possible. Then there's quantitative traders, which is basically they have a very good market intuition where they know how to use the developer's program, and they also know how to use the mathematical models. And then people from this field are often not finance majors. They usually have a background in math, physics, statistics, or computer science. And then some of the major employers are firms such as Jane Street, Two Sigma, Citadel, and Renaissance. But then there's also major banks that employ quantitative quants, and that includes JP Morgan and Goldman Sachs. So the overall conclusion of this is quantitative finance is more about minimizing risk and maximizing profit, and it uses machine learning and artificial intelligence along with large data sets to generate alpha, which is better performance. And models can always fail, which is why this is often a very high risk, high reward field because if your model can make $5 million, then that's good. But if your model loses $5 million, then it, it's the trade off. It's very profitable, but it can be very risky. And one of the major examples of why models can fail is because there are often black swan events where the market does something very unusual, like the 2008 financial crisis, and so then they don't work properly, and that leads to lots of money being lost, and firms often fail. Do you have any questions?
I think if we don't have any, we have any other comments or ideas. Okay. I did a really good job with the presentation. For the finance members who are on this call right now, just know that um, within the coming weeks, we'll start really getting more in depth with this, and then we'll start to produce output and do a different stuff with that. And Yin and Haris will kind of help you guys, and Taejons too will kind of help you guys um, with like the learning aspect and also uh, starting a research paper. Okay, you can stop recording now.